everyone's talking about quality tech and commodities. Like, give me something a little bit more interesting. So that's what I'm going to hope to do here. In terms of portfolio construction, what we've done is we've gone back to 1973, which you can see on the two top charts here on page 25. And we've basically said, what is the optimal portfolio to keep track of inflation? So an optimal portfolio for a 0% real return. So what's the best portfolio to keep track of inflation during volatile growth and inflation periods, i.e. 1973 to 1990, and then in periods where central banks have more credibility. And you can think to yourself if you think central banks are credible or not, or less credible, but these are kind of like the two outcomes here. So I'll focus on the left, which is more volatility. Well, over a 2, 5, 10, and 30-year period, cash actually does best because this might be like oxymoronic, like, wait a minute, in an inflationary period, you want to hold cash. Well, the issue is that when you are in a volatile period, financial assets are volatile, and cash you can think of as an option to buy financial assets when those financial assets sell off. So let me give you an example of one of those financial assets that we're waiting for the sell-off. If you look at the optimal asset allocation here, you can see that you don't want any allocation to nominal bonds because inflation's high and volatile. Instead, you want an allocation to inflation-linked bonds. Now you might say, well, hold on, Aidan, that's great in theory, but there's not that many tips out there. It's a liquid and the Fed owns 22% of all tips, so what can I do? Well, if you look at the bottom left-hand chart on page 25, you can see the correlation between 7 to 10-year tips and mortgage-backed securities. There's a very strong positive correlation between the two. So you can use mortgage-backed securities as a proxy or as a replacement for those inflation-linked bonds. Now, here's where the cash component becomes important. As the Fed tapers, they're going to be buying less MBS, right? Well, as the Fed buys less MBS, you are going to see a massive sell-off in mortgage-backed securities in our view, and you're going to see those yields spike because you're going from a market dominated by a price-insensitive buyer, i.e. the Fed, to more supply for the private sector who has like a return threshold that they need to meet. And so as the Fed tapers MBS or tapers, you're probably going to see MBS underperform treasuries in the short term as MBS yields adjust to what private sector wants. And that's when I'd be using this cash allocation to buy MBS as they sell off. Now, the other pockets that you'd want to be buying are equities and commodities, right? So equities, we've talked about like large cap quality tech in the US and in Japan where they're growing earnings. But there's some other pockets as well that I don't think many people are talking about when it comes to inflation hedging or proofing your portfolio. So let's turn to page 24 here. If you have more volatile inflation and growth, you tend to have more market volatility, right? More financial asset volatility. Well, we think that you should invest in firms that will benefit from this volatility, such as you can see on the bottom left here, commodity and equity exchanges and brokers, because they don't care where Apple price is, they don't care where lumber price is, they don't care where asset prices are in general. All they care about is there volatility? Because the more volatility, the more trading revenue that they see, right? So I think that they're a pretty big beneficiary of this inflationary trend. They also tend not to be as reliant on goods or commodities as inputs, right? So they're more immunized to high energy prices or high copper prices. It doesn't matter for them. The other pockets I look at are sectors that have had a track record of growing income faster than inflation, i.e., who are the sectors that are going to be able to pass on these costs to consumers and buttress their margins? Well, if you look on the bottom right-hand chart on page 24, there's 3 sectors that have this ability that I'm showing here, but there's also a fourth, which I'll explain in a moment. So what this bottom right-hand chart shows you on page 24 is net income of specific equity sectors divided by core CPI. So you get, and I've rebased it. So who's able to grow net income at a faster pace than inflation? Medical care services, medical care equipment, real estate. Also, utilities. If I was to graph utilities on this chart, it wouldn't look that great because you can see here that these rebase numbers are like, 1100, 1700, 2600. If you look at utilities, that number is going to be 200. So it's going to be quite lower, but they are consistently able to pass on rising costs to consumers. And also, utilities pay a much higher dividend than you get anywhere else, right? So that's kind of how I think about portfolio construction from an equity bond perspective. Give me the inflation linked. There's not many tips. So give me the MBS once they sell off. And then also give me sectors that have a proven track record of growing EPS faster than inflation. So medical care services, equipment, real estate, utilities, the exchanges and brokers, and then large cap quality tech, both in the US and Japan, because they continue to post very good sales and earnings. And then on the other side, you have the commodity producers that I haven't got into, but we also like the streaming and royalty firms because they actually have no operations. So if you think about like a copper company, copper prices might be going up, but it's very energy intensive, it's very labor intensive. And so their margins might be squeezed by the rising energy and labor costs. If you are a streaming or royalty company, well, you don't have that issue, right? Because you're essentially buying the commodity at a discount and being able to sell that at a higher price to the refiner. So that's in a nutshell how I think about portfolio construction and allocation right now.